Are we staring down the barrel of another market meltdown? Today, we'll explore predictions around recession risks and economic turmoil.
Indeed, with insights from Dr. Lacy Hunt on job data revisions and Gareth Soloway's market comparisons to 2007, you won't want to miss this.
Welcome to Financial Insights in Minutes, where we offer time-saving summaries of the day's top financial news and economic discussions.
Today, we'll break down vital topics including market trends, interest rates, and stock analyses.
Let's jump into our video summaries to uncover what the experts are saying. Welcome to David Lin's channel. Today, we dive into a riveting analysis with Gareth Soloway, Chief Market Strategist at Verified Investing. Are our markets echoing the patterns of 2007? Let's navigate these waters.
Absolutely. Investors are feeling the heat as swings in stocks, Bitcoin, and gold raise questions about the future. Gareth is here to break it down, so let's get straight to the facts.
So, what's driving today's discussion? What's at stake in this resemblance to 2007?
The main thesis here is that the S&P 500's recent movements reflect the same psychology as in 2007. A few indicators suggest that we might be setting up for a trend reversal and potential downturn.
Let's dive into those key points. What are we seeing with the S&P 500?
Gareth highlighted that we're seeing a twin pattern, a significant pullback followed by a recovery, akin to the peaks and valleys of 2007. This could indicate a new all-time high, but watch out for the potential drop after.
And what about the Fed? What's their role in the current landscape?
The Fed's potential pivot is a critical aspect. History shows that when they start cutting rates, it often signals they're reacting to deeper economic issues, not merely to stimulate growth.
What should investors keep an eye on regarding monetary policy?
A weakening dollar and falling yields signal potential economic issues. Historical context shows that rate cuts can correlate with recessions, not recovery.
Gold has outperformed lately, right? What's fueling that?
Yes, as uncertainty looms, gold remains a safe haven, and increased purchases by central banks suggest they're anticipating turbulent times ahead.
What's the status of Bitcoin in this chaotic environment?
Bitcoin appears to be following traditional market trends, but remains volatile. Investment patterns indicate uncertainty, and it could experience significant fluctuations.
What do Gareth's predictions look like?
He foresees the potential for a market collapse after new highs. The key will be watching the indicators closely. Patience is a virtue in these turbulent times.
And what of gold? How's it poised for the future?
Gold is likely to surge past previous highs if economic instability increases, presenting a solid investment opportunity.
All right, let's tie it all together. What's the bottom line here?
Investors should tread carefully. With the markets mirroring 2007 and economic indicators pointing toward risk, staying informed and vigilant is crucial. Better safe than sorry.
Final thoughts. Do you believe the markets are heading for a crash?
Let us know your thoughts in the comments. The conversation isn't over yet.
Welcome to Eurodollar University. Today, let's dive right into the turbulent waters of interest rates and uncover their true nature.
Absolutely. The discussion revolves around how low interest rates are being misinterpreted as signs of economic strength rather than underlying weakness. We're about to unravel the complexities here.
So, what's the core thesis of today's chat?
The gist is that persisting low interest rates are often incorrectly seen as a government manipulation or positive economic indicator, when in fact, they signal impending economic struggles.
Let's break down those key points. What's happening with these low rates?
Right. Low interest rates are now indicative of economic weakness, and economists are misunderstanding the market signals, thinking they suggest growth.
What about this intriguing activist treasury issuance? How does it play in?
This theory posits that the Treasury manipulates debt issuance, affecting yields. However, it's merely responding to economic conditions, not orchestrating them.
What's the big confusion in economics at play here?
Many see interest rates as manipulated tools rather than indicators of true economic conditions. It's almost like they're seeing the world through a tint.
Looking ahead, what are the predictions for the economy based on these rates?
The forecast isn't pretty. Low rates are likely to foreshadow deeper economic issues rather than the recovery many hope for.
And the markets expect more drama?
Absolutely. The continued misinterpretation of low rates will keep the markets on edge, leading to more volatility.
So let's wrap this up. What's the essential takeaway?
Interest rates are more about revealing the current state of the economy than about government manipulation. Understanding this can guide smarter investment decisions and policy discussions.
As we conclude, what strategies should investors consider?
Stay alert to market signals rather than getting caught in the manipulation narrative. Strategies should pivot towards safety and liquidity investment.
We want your thoughts. How do you feel about the future of interest rates and the economy?
Drop your insights in the comments. It's vital to track how these economic currents will affect us down the road.
Welcome back, everyone. Today, we're navigating the turbulent waters of the stock market with fresh insights. All eyes are on Nvidia as we await their earnings report later this week.
Absolutely. Today's show dives into key market trends, upcoming economic indicators, and a few surprises that could shake up trading. But don't fret, there's plenty of opportunity out there.
So, what's the central theme for today? Why is everyone holding their breath?
The key thesis is that Nvidia's upcoming earnings could be a game changer, impacting not just its shares, but the entire market. Traders are on edge, parsing every economic data point beforehand.
Let's talk calendar. What should traders be keeping an eye on?
First up, today we've got the home price index and consumer confidence figures hitting the tape. These reports can stir up some serious market dynamics, so keep your strategies flexible.
Let's dive into Nvidia. Why is this report so crucial?
Nvidia is arguably the most anticipated earnings report on Wall Street right now. If they exceed expectations, we could see a significant market rally, but a miss might trigger a sharp pullback.
What's the vibe in the market overall?
We've seen recent pushes towards key support levels. Observing these trends can point to either breakout opportunities or potential breakdowns, giving traders ammunition for their next moves.
As we head closer to Nvidia's earnings, what do you foresee?
Expectations for heightened market volatility are certainly building. If Nvidia surprises us positively, we could see stocks rally significantly.
How could investors react post-earnings?
If Nvidia delivers a strong performance, we may witness a resurgence of bullish sentiment. Conversely, disappointment could lead to a decline in investor confidence.
In wrapping up, what should traders remember?
Keep your strategies flexible. With the economic calendar and Nvidia's earnings looming, the market's next moves are poised to be impactful. Stay sharp and adapt.
As we finish, how do you plan to navigate these market currents?
We'd love to hear your strategies in the comments. Let's keep the conversation flowing as we tackle these market waves together.
Welcome to the Julia LaRoche Show. Today, we're navigating some choppy economic waters as we discuss a significant downward revision in jobs data with the esteemed Dr. Lacy Hunt.
Indeed, Dr. Hunt is back, and he's ready to break down how these job numbers affect everything from consumer spending to our overall economic outlook. Let's get straight to the facts.
So what's the crux of Dr. Hunt's message today?
The core thesis emphasizes that the recent downward revision of job data exposes underlying flaws in measuring our economic health. It affects not just current statistics, but our understanding of factors like income and productivity too.
Let's dive into some of those key points Dr. Hunt laid out. Starting with that major revision in job figures, what does it mean?
This revision doesn't just alter employment numbers, it directly affects calculations of personal income, overstating GDI, which can mislead policy decisions.
What are the broader implications of these discrepancies in data?
Flawed data leads firms and investment managers to base decisions on incorrect statistics. This could have far-reaching effects, especially in monetary policymaking.
Dr. Hunt emphasizes something critical, the state of national savings. What's he pointing out?
He highlights that the negative net national savings over multiple quarters signal real problems, threatening household economic stability and reducing overall investment capacity.
What predictions does Dr. Hunt make regarding the economy's future?
He predicts rising inflation pressures will exacerbate economic difficulties, straining consumer purchasing power as prices continue to escalate.
And what about the employment landscape? What does Dr. Hunt foresee?
He anticipates that inaccuracies in labor data could prompt significant challenges in the job market, especially within the small business sector, where employment rates could decline.
Wrapping up, what's the big takeaway from the discussion?
The pressing need for accurate economic measurements is vital to inform sound policy decisions. Without it, we risk repeating mistakes that could harm our economy further.
What final thoughts does Dr. Hunt share?
He underscores the necessity for government accountability in economic data reporting to ensure the integrity and transparency necessary for sound economic decision-making.
As we conclude, what are your thoughts on today's economic challenges?
We invite you to comment below with your perspectives. Let's continue the conversation on the economy and its future.
Welcome to Thoughtful Money. Today's intriguing topic: how are low interest rates impacting economic stability? We have the pleasure of discussing this with the insightful Thomas Hoenig, an expert with an extensive background in Federal Reserve policies.
That's right. Thomas brings unique insights as the former CEO of the Kansas City Fed. He sheds light on how these interest rate adjustments are more than just numbers. They influence our everyday lives and economic health.
So, what's the crux of today's discussion?
The primary thesis centers on the caution required when implementing interest rate cuts. Although a cut may seem beneficial, it can destabilize the economic system if not handled properly.
Let's dive into those key points. What's the first one about low interest rates?
Low interest rates can act as a subsidy to borrowers, potentially encouraging excessive risk. This shifts the balance of favor from savers to those accumulating debt.
Next up is the relationship between monetary and fiscal policies. What's happening there?
The interplay is essential. While monetary easing might appear beneficial, without sound fiscal policies, it can lead to misallocation of resources and a lack of sustainable growth.
What about future predictions? Which concerns should we have on the horizon?
The looming risks involve asset bubbles and escalating income inequality, leading to greater societal dissatisfaction if not addressed properly.
What about predictions on inflation?
Future rate cuts pose a risk of fueling inflation again. How the markets react may not follow the historical scripts we've seen.
And what can we expect in terms of fiscal policy?
As the government faces economic pressures, spending may increase. The risk is that this can create enormous debt levels that affect future monetary policy.
As we wrap up, what are the key takeaways?
We've learned the importance of cautious interest rate management and fiscal discipline to avoid destabilizing the economy further. After all, reckless decisions can lead to inflation and asset bubbles.
What's one more key takeaway to consider?
Encouraging public awareness about fiscal and monetary policies is vital. An educated electorate can hold leaders accountable for their financial decisions.
Ahoy there! Welcome to the Technical Traders. Today we're diving deep into the waters of technology stocks like Nvidia, Tesla, Amazon, and Apple. Why are these stocks making waves in the market?
That's right. The charts are flashing signals, and our expert is ready to dissect them. Stick around as we uncover potential trends and market movements that are shaping the future.
So what's at the core of today's stock analysis?
The thesis is clear. Despite showing mixed performance, key tech stocks are positioning themselves for a potential bullish run, and it's crucial to understand the patterns forming on the charts.
Let's kick off with the broader market trends.
Right. The markets are slightly down, but the S&P 500 is strategically positioned just above its 5-day moving average, suggesting momentum could swing either way.
What about Nvidia, our favorite chip maker?
Nvidia is looking ripe. It's currently flagging sideways, and history shows that it could break out soon, especially with its recent pause at the 5-day moving average.
And how about Tesla? Is it navigating through rough waters?
Indeed, it's faced some turbulence but is forming a bull flag pattern. A successful breakout here could mean significant upside for investors.
Let's chat about Amazon and Apple.
Amazon appears bearish under the key moving averages, while Apple is holding strong above its averages, a critical point for the upcoming weeks.
What predictions does our expert foresee?
If key tech stocks make a move, it's likely to trigger cascading effects in the market. Buying opportunities may arise. It's time for traders to gear up.
What about the tech sector specifically?
Oversold signals suggest a rebound is on the horizon. The tech sector, in particular, is ripe for correction and potential gains.
So what are the key takeaways from today?
Traders should remain vigilant for bullish patterns in tech stocks as the market recalibrates. Keep your eyes peeled for breakout opportunities.
Before we sign off, how are you planning to navigate your trading strategy?
Drop your comments below. Your insights could illuminate paths for fellow traders navigating these waves.
Welcome back to Figuring Out Money, folks. Today, let's dive right into the big topic on everyone's mind, the potential economic recession puzzle that's starting to take shape.
Indeed, we're unpacking a lot today about the 11 S&P 500 sectors, their signals, and what it all means for our economy. Trust me, this is going to be one enlightening journey.
So what's the central thesis here? Why are we tuned into the S&P 500?
The thesis is clear. The S&P 500 sectors are slowly piecing together signals pointing towards an economic downturn. And let me tell you, each piece is sending out serious alarms.
First point, the Fed seems ready to cut rates, right?
Correct. There's a 71% probability of a 25 basis point cut in September. But remember, rate cuts often signal trouble ahead.
Let's simplify this. How do market cycles relate to a recession?
Well, the market often peaks before economic downturns. Right now, defensively placed sectors like real estate are on the rise. Sounds familiar, doesn't it?
Now, strategies aside, what can investors do right now?
Investors need to stay savvy. It's critical to read those market signals right. Buying the dips or selling at peaks matters more than ever.
Looking ahead, what are the predictions from this analysis?
First prediction aligns with rate cuts. They could amplify current economic tensions and spark increased market fluctuations.
And what about the sectors? Who's likely to gain ground or take a hit?
Defensive sectors like healthcare might thrive further, while tech stocks could falter if market sentiment turns sour. It's a real balancing act.
As we wrap things up, what should we take away from all of this?
Staying informed is crucial. Investors need to remain vigilant, continuously analyzing economic indicators and trends to ensure they're navigating these choppy waters effectively.
We want to hear from you. What strategies are you considering against these possible market shifts?
Comment below with your thoughts. It's a great chance to share insights and strategies with fellow investors.
Welcome to Blockworks Macro. Today's episode is a special edition called Fishing and Finance, where we're live from the breathtaking Maine lakeside with Jim Bianco and Jeremy Schwartz.
That's right, where fishing meets finance. We're poised to dive into the latest economic trends, regulatory changes, and how they intertwine with the political landscape as we navigate this tumultuous week.
So, what's the core of today's discussion?
The crux of today's conversation revolves around economic signals that are all over the place. Yet, regardless of who occupies the Oval Office, we're bound to see a deficit president steering us through fiscal waters.
Let's touch on the economic signals first. What's the latest?
The job market had a rough start as payroll reports disappointed, but retail sales bounced back, highlighting a mixed economic picture that really keeps analysts on their toes.
What about the Federal Reserve stance?
The expectation is that the Fed will cut rates, but amid the volatile data, the market is unsure whether these cuts are aggressive enough.
Let's tackle unemployment next. What's brewing there?
There's fear that rising unemployment could point towards a looming recession. What's fascinating is how shifting labor forces might be skewing these stats.
Now switch gears to politics. What are the implications there?
The upcoming elections are keeping markets jittery. Interestingly, neither candidate seems to be swaying market sentiments decisively. It's a perfect storm of uncertainty.
On to predictions. What can we expect?
One key takeaway is that regardless of the election outcome, high deficits appear inevitable, with pressing questions around long-term fiscal policies and their impact on the economy.
And what about interest rates?
Expect gradual adjustments from the Fed. If they're too aggressive, we might see unforeseen market reactions as investors assess the balancing act.
Wrapping it up, what's our final takeaway?
We're facing choppy waters as we navigate through an uncertain economic landscape, driven by both political maneuvering and monetary policy shifts. What are your thoughts on how these forces will play out?
That wraps up our exploration of potential recession warnings and market signals today.
Experts shared vital insights that underscore the importance of vigilance as we navigate economic uncertainties.
Be sure to stay tuned for more discussions and updates on these pressing economic matters.
Thanks for joining us. Follow for more timely financial insights.
Thanks for watching Financial Insights in Minutes for August 27th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.